Welcome everyone, my name is Kim Chicoine and today we're going to be talking about debt management. In a recent press release on March 9th, 2023, Equifax stated that the overall consumer debt in Canada rose in the fourth quarter of 2022 by $2.37 trillion, which was up more than 6% from the same period in 2021. They also found that credit card debt had increased by more than 15% during the same period and for the first time had totaled more than $100 billion. Mortgage debt contributed to 75% of overall consumer debt in Canada, and many of these mortgages are on 5-year fixed rates that will be renewing in 2023 and 2024. As Canadians face greater financial pressure due to elevated inflation and higher costs of borrowing, it is increasingly important to focus on what you can do to manage, lower, and eventually eliminate your debt. Whether you have a line of credit, student loans, a mortgage, or credit card debt, or all of the above, it's important to know where your debts are, how are you currently paying them down, and then to make a plan on how to eventually eliminate those debts altogether and to avoid taking on more debt. When you list your debts, you're going to give yourself a clearer picture of what you owe. First, you're going to want to list what you owe, the minimum payment that is required, and what you're currently paying, as well as the interest rate and whether it's a fixed or variable rate. Once you have that list completed, ask yourself why and how each debt was accumulated. This is going to provide yourself with clarity as to how that debt was accumulated and common pitfalls for yourself to avoid so as to not accumulate more debt. Once you have this completed, you're going to want to review, or maybe you're going to create a budget. This is going to help yourself get on track and pay down your debts as quickly and as efficiently as possible. When you create a budget, you're going to put your needs before your wants. Some common needs, or what I call non-negotiables, are housing expenses, groceries, but not eating out, transportation costs, and debt payment. Budgeting is all about spending less than you make. So by cutting out those unnecessary expenses, you can either put that money towards excess spending or debt repayment, or maybe just find if you are overspending. However, without knowing where that excess spending is, it's going to be really hard to cut it out. As well, if that debt is due to your excess spending, budgeting is going to help you prioritize your expenses and then cut out those unnecessary expenses that led to your debt accumulation. Once you have your budget made, you can then decide on a strategy to attack your debt. First, choose a time frame that you want to either lower or eliminate your debts by, and write it down. By writing down your debts, your subconscious is going to work towards your goal, and that written goal is also going to help act as accountability for yourself. Next, decide which debt you want to pay off first. There's 2 different methods when paying down debt. The first method is the snowball method, which means that you'll make minimum payments on all of your debts and then make extra payments on the smallest loan. Once that loan is paid off, then you're going to move on to the next highest loan debt. The second method is the avalanche method, which means that you're going to still make minimum payments on all of your debts and then make extra payments on the highest interest rate loan. Once that loan is paid off, then you're going to move on to the next debt with the highest interest rate. The key to both of these methods is that once the debt is paid off, that you continue to put the same monthly payments that you were previously paying onto the next debt. That way your monthly debt expense on your budget is going to stay consistent and your debts will be paid off faster. If you're still finding it hard to pay down your debt, you may want to consider consolidating your loans to a lower interest rate. A consolidated loan is essentially just taking all of your highest interest rate loans and consolidating them into a lower rate. When shopping around, it is important to note that applying for loans with different lenders within a short period of time can affect your credit score and thus your ability to actually get a lower interest rate. Therefore, I recommend talking with your lenders prior to making any applications with them and seeing what types of rates they can provide you. Again, you'll want to try to keep your monthly mortgage or monthly debt payments as you had them previously so as to help you pay down your debts faster. The next step might seem obvious, but debt can sneak into your budget without you paying much attention to it. So once your tendency is to rely on debt, it becomes a lot easier to justify financing a purchase versus saving for that purchase. For example, financing a new car versus saving for a new one. When you save for future purchases, you pay yourself the interest, but when you use debt for your purchases, you're going to pay the bank the interest. Therefore, by relying on loans, you continue to repeat the cycle of paying off debt only to assume more debt, all the while paying the lender a premium on your own money. At the end of the day, if you're finding it hard to navigate your options, there are plenty of professionals who can help. And before you sign up for any paid services, explore your options and compare the different services offered. The Government of Canada's websites has links to different non-for-profit counselors or licensed insolvency trustees. These people will help you address your situation, develop methods to help you get out of and stay out of debt, and to help you with how to deal with your creditors. One of the hardest steps in debt management is admitting to yourself that you need help. So I thank you for taking the time to watch this video, and I believe that you can navigate yourself to debt freedom.